Today, we're going to cover the most misunderstood stock in the market. I believe this stock could double its earnings by full year 2026. It has two major catalysts waiting to push the stock price up. The first is that this stock has levels of pricing power that most companies dream of. The second, as the Federal Reserve begins to cut rates, this stock directly benefits. And with plenty of reason to believe the Fed will be dovish going into 2026, we could see Fico's earnings explode. Now that you know the stock is Fico, you're probably thinking, boring finance company. But give me a few minutes of your time and you will finally understand why Fico is priced for greatness but still has so much upside. Without further ado, let's get into the video. Fico stock is set to explode. But to know why it's set to explode, we need to know what Fico does. Fair Isaac Corporation, or Fico, has established itself as the industry leader in credit scores. This has turned out to be a very lucrative business. Over here you can see the Fico score from 300 to 850, and if you live in the US you probably use this all the time. Over in the UK we don't really use Fico scores as much. It's very much native to the US and it's essentially just your credit score. Now, credit scores are used for more than just individual lending decisions. They are actually benchmarks used by investors, lenders and the whole industry. And we'll get to that a bit further and a bit more in depth in a minute. So when we look at Fico's revenue, you can see that about 58% of the revenue is made up by scores. The other is professional services over here and then software. What you'll notice is about 80% of the profits is from scores. So the net income, you got about 81% from scores and 19% from software. When it comes to the EPS, you can see incredible growth from Fico. And this is why it trades at a PE of 65. It's growing its EPS by 34.4% year over year. This rapid growth is literally due to them increasing the price at which you can buy a Fico score, a credit score. So I'm just going to give you a little bit of history behind Bill Pulte and the Vantage score, why the price has dropped so much. So Bill Pulte works for the FHFA, which is essentially a government agency overseeing the housing market, and he has been tweeting and that has been affecting the stock price a lot. He first tweeted and said that he was extremely disappointed to hear about the cost increases by Fico onto American consumers, and this caused the stock price to drop by about 28%. He later tweeted that he was going to increase competition to the credit score industry by essentially allowing lenders to use Vantage Score 4.0, which is a competing score. Now this pushed the stock price down another 27%. So based on this, I said in my first video, which is worth a watch, I thought that there was going to be no price increases from Fico for a little while. And I thought that this was going to slow down the EPS growth a little bit, but I was so very wrong. Since then, Bill Pulte has changed his mind a bit and he says Fico really is outplaying the credit bureaus. A lot of people are saying he can't keep getting away with this, just completely manipulating the stock price. It hit a bottom of about 1300. I bought in at about 1380, and since then it's gone up to about 1600 into the 1700 range. One point it peaked massively. So what happened? What actually happened? Well, to explain what happened, I need to explain a little bit about how Fico's moat was deemed to be under attack by the Vantage score and how Fico's moat is actually incredibly strong. To understand the moat, we must understand Fico in the mortgage and lending industry, underwriting and benchmarking. Fico has the craziest moat and your understanding will change forever. Now you might have seen this already, but trust me, it's worth the recap. So we have the borrower and the bank. The borrower says he wants a loan of about $300,000 for a mortgage. The bank says, I need to check this guy, check him out. He goes to the credit bureaus who generate credit reports on the borrower. We have the Fico score over here. Now, each credit report requires a Fico score using the data within the credit report. This gives Fico about 495 per credit score, which is one for each credit report. This is called a tri-merge. Now, the tri-merge resellers are essentially the people who directly communicate with the bank. So the credit reports go to the tri-merge reseller and the tri-merge reseller gives that to the bank. They put a tiny little fee on top. The bank has now checked the borrower and the bank thinks it's okay to give this borrower a mortgage of $300,000. But the thing is, the bank wants its money back straight away. I want my money back now so that he can loan it out again. Now, this is where Fannie Mae and Freddie Mac come in. Essentially, Fannie Mae and Freddie Mac buy the mortgage off of the bank so that the bank can get its money back. But before it does that, it just quickly double checks that all of the data on the borrower is correct. And this is where it checks with the reseller. So Fannie Mae and Freddie Mac request the data again. And this means 3 more pulls for the Fico score, which adds another $1, $1, and $1. So they get an extra $3 there for each pull. For each reissue of the score, they get an extra $1. After that, they say, right, okay, we're all good to go. Pay the bank $290,000. The bank has still made money because it's charged various fees onto the borrower when it lent out that money. So the bank still made money. It's got its money back, so it can loan out money again to another borrower, and everyone is sweet and tidy. So what happens after the mortgage goes to Fannie Mae and Freddie Mac? Well, this is called the secondary market. And this is where the benchmarking element of the FICO score comes in and where their moat really shines. So Fannie Mae and Freddie Mac, they take many mortgages that they've received and they pile them up into something called an MBS, a mortgage-backed security. Now, investors come along and they say, we want to buy this MBS. What are its return rates and its risk levels? So on the MBS, you can see that it has a yield of 4% because that is the average interest rate that a lot of the borrowers are paying on the mortgage. And the MBS also has an average FICO of 717. Now, this is how the investors judge its risk level. Of course, a lower score means that they are more likely to default on their debt. And therefore, that MBS is worth less because investors want the best FICO score on their MBS. Now, this whole system offers liquidity to the mortgage market, allowing the economy to run smoothly. And there are similar processes for all types of loans. So why not just swap FICO for the Vantage score? Why is it so essential that FICO gets used? Well, here we have two versions of the mortgage-backed security. One is FICO and the other is a Vantage score. One has an average FICO of 717, the other has an average Vantage of 820. Along come the investors and they say, for the FICO score, they say, we understand how this works. After 50 plus years, we trust it, we understand it, we know how it works. We can plug it in to all of our models and it runs very smoothly. We know what we're going to get with this. Now the investors come and they have a look at the Vantage score side of things and they say, look, we don't understand this language. What is an 820 Vantage? They've used FICO for so long, they don't understand it. We need to recreate our financial models using Vantage now, and that's going to take a lot of time, and we're not going to know how accurate the models are going to be. Fannie and Freddie's risk models must have also been altered, so can we trust it? Can we trust that they have the right risk for this mortgage-backed security? Why did the lender even use Vantage score in the first place? Is it because it gave them a higher score? In the end, they say, look, we are not going to buy this. This is too much risk for little reward. Remember, they're both yielding 4%. So the investors, they leave. At the end of the day, we need to sell this mortgage-backed security so that there can be liquidity in the mortgage market. So how do we get the investors back? Well, the easiest way is to increase the yield of the mortgage-backed security. All of a sudden, the investors are interested again. They say, okay, we will buy it now. But what happens because we've raised the yield? Well, the borrower that went to the bank using Vantage score, unfortunately, the bank said, look, there's going to be a higher interest rate on your loan because we need a higher yield to sell to the investors. So the borrower says, look, okay, I'll just go to a bank that offers a lower rate. And of course, that is FICO because it only needs a yield of 4%, meaning they're only charging an interest rate of 4%. Look, FICO therefore has a huge moat in scores. An example of this is that Toyota Motors Auto Financing Unit, TMCC, even though TMCC originates its loans using a Vantage score, it then has to use a FICO score anyway to describe its loans to investors. So it's getting a FICO score and a Vantage score. So every time it uses a Vantage, it's just getting a FICO score anyway, and FICO is still making money. One Main Holdings, which Citigroup sold in 2015, notes in its 10K that while management does not utilize FICO scores to manage credit quality, we group FICO scores into the following categories for comparability purposes across our industry. FICO notes that 98.8% of securitization solely cite FICO scores as a credit risk measure. So what happened recently for a lot of investors to regain faith in the stock and for the stock price to start moving up again? Well, there was a huge change to how FICO sells its scores. When we go back to mortgage origination, we have the borrower wanting a loan, the bank checks him, the tri-merge report is generated, given to the tri-merge reseller, and then the tri-merge reseller is directly interacting with the FICO score. This takes the bureaus out of the equation. So FICO sells 3 scores, the tri-merge reseller gives the bank the tri-merge report, the borrower and the bank exchange, Fannie Mae and Freddie Mac receive the mortgage and they say, look, we're going to double check your data is correct, and this time there's no reissue fee. So in this model, option A, there is no reissue fee. So the mortgage is confirmed and the borrower then has to pay $33 per FICO score. If the mortgage is confirmed, then the borrower has to pay $33 per score per person. So if this was a couple, they would actually be paying about £200 here instead of $99. So that's option A. FICO have given us 3 options. This is option B. So the borrower and the bank, they interact, and this time the tri-merge reseller receives the tri-merge report, and FICO and the tri-merge resellers directly interact, and the tri-merge reseller pays $10 for the 3 scores, each Equifax, Experian and TransUnion, and it gives it to the bank. The interaction between the bank and the borrower happens. Fannie Mae and Freddie Mac come in. They say we're going to double check your score, and this time there's a reissue fee of $1 per score. So in this case, FICO has made $11 per score instead of the $5.95 they were making previously. So there was a reissue fee and that gets sorted. Now option C, the bank and the borrower interact, and this time it's the same as it was before. The FICO score goes through the bureaus, but this time it's charging $10 per score. Then goes through to the tri-merge reseller, which moves to the bank. The bank obviously interacts with the borrower. Fannie and Freddie interact, and then there is the reissue fee of $1 per score that is paid to FICO. So yet again, $33 for FICO. So essentially what has happened in these 3 options? Well, the bureau markups have been removed. The legacy model, lenders via the bureaus were paying about $10 per FICO score due to the markups. Obviously FICO was only charging $4.95, but then the bureaus were adding an extra $5 to that and charging $10 to the resellers. This has essentially taken the power from Equifax, Experian and TransUnion and given the power to FICO. Now FICO is claiming that they're saving 50% through option A because they're only charging $4.95 per score. Of course, this is only if the loan doesn't close. If the loan does close and the origination gets complete, they get that $33 loan completion per borrower per score. Now this obviously might not happen, so it's hard to know what they're going to get paid per application. Something to consider with option A is that the tri-merge resellers will now have to take on increased amounts of administrative tasks. And look, the tri-merge reseller will likely add a markup themselves. But at the end of the day, all that FICO was really doing was increasing their scores whilst pleasing the FHFA and Bill Pulte. By the looks of things, that has worked, with Bill Pulte obviously tweeting out that FICO is playing the credit bureaus. So look, the bureaus are fighting back. They've lowered the price of a Vantage score to $0. But the thing is, they've actually been trying to compete with the FICO score for about 20 years. And look, even if they take 10% market share, it will have minimal effect. I've discussed this in my other video. So let's look over the new options going into 2026 with the old model making about $17.85 for FICO. We know that option B makes $33, which is an 85% gross profit increase, which is just huge. And then option C, exact same, 85% gross profit increase. Now, if we look at option A, if the loan gets rejected, they've actually lost about 17% in their gross profit because it's only $14.85. But if the loan is accepted, they're making $113.85, which is a 638% gross profit increase, which is just absolutely insane. When we have a look at mortgage applications and originations, we can see that about 5.7 million originations were complete, and there was about 10 million applications, which is about 57%, and this was for 2023. In 2022, we had about a similar amount. There was 8.4 million originations with 14.3 million applications, so just over half of the applications got accepted. So what I've done is I've kind of averaged and said, look, half the time it's going to get rejected, half the time you're going to get accepted, and this means that on average it's a 360% gross profit increase, an average of $64 per mortgage application. Now, when I go to do my valuation on the stock later, I do not actually take option A into account. I stick with option C, which is just the 85% gross profit increase. You'll see what happens to the stock even with this applied. I think when it comes to option A, we need to wait until we see guidance in order to see the effect that this could have. So this isn't the only catalyst going for FICO. So over here we have the mortgage application index, and you can see that when mortgage rates peak, typically the amount of mortgage applications drops down. So about 12 months ago, we were actually sitting at 250 on the mortgage application volume index, and now we're sitting at 320. Now, this is obviously really good for Fico because it means that there's going to be an increasing need for Fico's scores. Every application needs Fico scores. Rates also will continue to drop probably into the new year, and you can see the effect the one rate drop has had. This spike here in September is the rate drop. You can also see that we are on a steady upward trend since the beginning of 2024. We're beginning to see more and more mortgage applications go in, and I believe this will probably continue. But for the sake of safety, I'm just going to presume that it stays at 320 for the next year and a half, which is an increase of 28% from 12 months ago. So now we can see the crazy effects of the price increases. I've made what I believe are some realistic assumptions, and I think that by full year 2026, we could see about 1 billion in net income for Fico. Now, I know a lot of people probably think this is unrealistic, but let me explain myself and you might understand it a little bit better. So option B and C gives us 85% price increase for mortgages, but does not take effect until 2026. So for the second half of 2025, we used the 50% price increase, which was from 350 to 495. That happened at the beginning of 2025. We haven't seen the effects for that yet. So this gives us an average CAGR over 1.5 years of 73% for mortgage price increases. You can see the percentage of earnings at the moment that are from mortgage scores, the percentage of earnings from other scores, and the percentage of earnings from software. Now it's 32% for mortgages, 48% from the other scores section, and about 20% from software. And my next presumption is that the other scores will continue growing at a 10% rate or a 10% CAGR. But when it comes to mortgages, I've said that there'll be a significant mortgage volume increase by about 18%. Now that is obviously about 10% lower than the 28% increase that I showed you a minute ago, and that's happened over the last 12 months. You know, if the volume continues to go even higher, we could see even crazier results. I've also presumed that Vantage score takes a 10% market share. This is reflected here. If you're shocked at how little difference the Vantage score makes, go back and watch my first video. You'll probably understand a lot better why it makes such a little difference. I've also said the software business will grow at a 3% CAGR, and the buybacks will be about 2% over 1.5 years. Now this just increases the net income from the mortgage scores drastically to about 600 million. This is why we get such a high net income by the end of 2026. This gives us an EPS CAGR of about 45%. Now currently it trades at a PE ratio of 64. I've shown you a full range here from down at 35 up to 65, which is where it's sat at the moment. Amazingly, if the PE ratio stays at 65, you'll see a huge CAGR of about 45.36%. Now let's be real, these percentages are not meant to be specific. They are not guaranteed. These are just supposed to be estimates. Of course, add your own margins of safety to all of the numbers shown here. If we were to get multiple compression and the stock were to drop down to 35 PE ratio, you'd see a slight decline of about 3.79% over the 1.5 years. But look, even if the stock drops to 45%, you're still getting about 13.76% CAGR, which will probably likely outperform the market. But if the earnings come in so strong, I highly doubt that the PE ratio is going to drop drastically. It might drop slightly, but even then you're receiving some large payouts of 30 and 37%. Let's remember, in the short term, the market is a voting machine, and in the long term, it is a weighing machine. So in the long term, the PE might drop, but in the short term, we could see some huge spikes in price. I know a lot of you right now are probably highly doubting the fact that they can achieve this. So here are some reasons that I could be wrong. The MBA purchase index may drop back down, meaning less volume. So obviously the MBA purchase index has been slowly rising with rate drops continuing. I believe it will continue to kind of go up. In my presumptions, I said it will stay flat, but here's the thing, I can't predict the future. It could drop straight back down to where it was in 2024, and this would of course affect Fico's earnings. Now also, I have made assumptions on the composition of Fico's net income. And how have I done this? Well, I've done this using Morningstar Equity Analyst Report. They said that they believe that mortgage revenue is about 40% of scores revenue, and we know that 81% of the net income is from scores. Now you can check this on your favorite platform. Mine is Fiscal AI, and I'm using it here to demonstrate that they are already at a run rate of $727 million. This is just 181 times 4. And look, they are consistently growing their net income. Their last quarter was 44%. So we're really not that far off 1 billion in net income, considering that they've just done an 85% price hike, and that's just the least of it. I haven't even included option A, which could offer a huge, about 300% increase in prices. Now, a lot of this depends on guidance. So what is my strategy going forward for the stock? I have actually bought more at these prices and will buy more tomorrow. The huge earnings could push the stock higher because like I say, it's a voting machine in the short term, and people might get very excited by the huge boost in earnings. If we see incredibly high PE ratios again of over 80, I might consider trimming my position a little bit. I just don't want to get too carried away. I'll only be trimming though. I don't think I'll be fully selling out of this position. If we see multiple compression, PE nearing 40, I'm happy to hold the stock long term, and I mean like long term, because it is a high quality compounder. I'm happy to hold it over a solid 5 to 10 years, as long as guidance from the management kind of says that they're going to continue with price hikes. Look, guidance from management in this next quarter will be key, especially with the new pricing options. If they announce slower price hikes going from 2027 onwards, we could see the stock drop due to its high PE of 65 already. Unfortunately, I didn't swing big enough when it was down at 1,300. I wish I did. I wish I put more in. I just didn't have the money at the time. But yes, I will be putting more in before earnings. So guys, that is it for Fico. But I have another announcement. I finally hit 100,000 US dollars. I'm so happy about it, honestly. The individual stock picking portfolio is flying up about 18,400 with a rate of return of 138.4%. And then my ETF account is also flying, mainly because I have exposure to Nvidia in the way of an information technology sector ETF. Here are my portfolio holdings if you want to have a look at them. And yeah, that is it for this video. Please give it a thumbs up. If you can, hype the video. That'll do me absolutely bits. Thank you for watching, guys. See you in the next one.
I'm hopping out Ferrari. My house is 3 stories. I'm still independent cause Jive couldn't afford me. The meetings were boring. For real, I was snoring. The VP was fine, yeah, she treated me kinda corny.